Well, welcome to Investor in the Family Radio. This is Brian Bain, your host, and we've got a special guest with us today, Kirk Spano. Kirk, welcome to the show.
Hi there, Brian.
Well, hey, Kirk, you are no newbie to the podcast, so it's great to have you back. And kind of what we're doing right now is Kirk wrote an article about a week ago on Seeking Alpha called Trading Oil and Oil Stocks Over the Next 2 Years. And Kirk is someone who I've respected for a long time as an investor, especially when it comes to commodity and energy stocks, plenty of other things as well, but he definitely has a lot of experience and background in this area. So when I saw that article come out, it was one that, hey, I wanted to bring you on the show and I wanted to hear more about it and learn more about kind of your thesis behind trading oil and oil stocks over the next 2 years. So Kirk, do you mind by starting us out in case people haven't read the article yet, and we can add a link to the article in the show notes, but people haven't read it yet. Do you mind giving kind of a brief background on your thesis?
Right. So for the last few years, there's been this lower for longer mantra about oil. And about 2 years ago, I started telling folks, we pretty much hit the low point in oil about 2 years ago, and the oil stocks followed. And I said, oil is going to gradually run back up into the normal range of $80 to $120 per barrel. And I got mocked article after article after article, even as the price of oil went up and up and up and up. So the trade to make money in oil actually was very successful the last 2 years, but now the trade is to make money in the oil stocks, which lagged the price of oil. And you have these folks out there who are saying, well, the shale stocks are never going to make money because they've never made money. And they just go on this whole tangent of, well, they've been cash flow negative and, they haven't made money. And they never try to explain what shale has been through, which has been a startup and then a crash in the industry. And now the new phase is that these companies have really slimmed down. They focused on the best oil patches out there, at least some of them, not all of them. And they really are lean, mean cash flow machines, especially if the price of oil goes up, which it has. We're at about $72 a barrel today on the WTI and higher on Brent. We're setting up to export more oil, which should drive even more pressure on price, create more pressure on price, and that will drive more money to the bottom line of a lot of these shale plays. And there's a whole list of companies that at 50 some dollars a barrel, 51, 52, are making money. So the question I think people need to ask is a quarter or two from now, when they start to realize $70 a barrel oil as their hedges come off at the end of the year, how much money are they going to make then? And then as they rehedge to higher prices in that $70 and maybe even $80 range for 2019 and 2020, how well will they be sitting on cash flow and earnings per share in 2019 and 2020, even if the price of oil goes down, if they hedge at much higher prices?
And just to be clear, again, for some people who may not be as familiar with how this works, so basically when you talk about hedging, pretty much any oil or natural gas company, they don't just sell at market prices every day. Like they hedge ahead of the curve to make sure they can lock in prices down the road, right?
Right, and not all of them, and not all the time, and not all of their oil. So the way to think about this is, today, to get oil out of the ground costs whatever it costs, say $40 a barrel, and they can sell it at 72. But a lot of companies have hedged, say, half or 2/3 or 3/4 of their production back down at $53, $54 a barrel, which is profitable. Those hedges come off, right? So the pre-selling of the oil contract ends sometime later this year, generally in December. So they will come in with new contracts to sell oil for next year and the year after, but they'll be using today's futures curves, futures prices on oil, which are much higher. So if they can get $70-ish a barrel, we really have to think about, okay, well, they're already cash flow positive and doing buybacks and paying down debt and paying out dividends at $50 some a barrel. what would that look like at $70 some a barrel?
Absolutely. Well, yeah, because and would you say that a lot of those producers or a lot of these energy companies are undervalued even at $50 oil?
There are certain companies that are.
Okay.
In particular, some of the more unloved companies share some characteristics, and that would be that they have some Canadian assets attached to them, or they have multiple fields, or they don't have the right transportation set up to get to market. And as the transportation changes, some of these companies are going to see a lot of unlocked value. As the price of oil goes up, lots of companies are going to do well because the price of oil goes up. But certain companies are at value prices still. And, I've got a few favorites that I'll share later. But, you could see a lot of these companies somewhere between double and triple in the next 2-3 years. Wow.
It's pretty compelling. How much does, and again, a little bit of background for some people, when you say shale oil, remind us of the primary geographic locations you're referring to in the U.S.
Right. So the most prolific oil field in America is the Permian Basin, but the one that most people know is the Bakken, because 5-6 years ago, when the Williston Basin in North Dakota was taking off, it was in the news, the resurgent oil boom. So that's the Bakken in North Dakota. You have the Eagle Ford in Texas. You have the Permian in Texas and parts of New Mexico, which is gigantic, and that's where the cheapest oil is. The Stack Scoop in Oklahoma, Niobrara. So, there's, I believe, 7 major shale plays, maybe 8, that are oil related, and then a couple more that are natural gas related. And there's actually a couple that aren't being developed at all, really. I mean, there's oil in Michigan and a little bit of natural gas in some other places, but we think of those 7 or 8 big ones. And where investors should be focusing is on the Permian Basin, because that's where the cheapest, easiest to get oil is, and it's very close to the Gulf Coast, which is where the refining is and where an export facility is that's adding bigger ships. They're making the port deeper so that they can accommodate larger ships.
And how much does natural gas factor into this? Is that usually a whole different ballgame? Like, you've got your oil shale fields, you got natural gas shale fields. There's a fair amount of overlap, isn't there?
There is. However, oil is typically oil and gas is typically gas focused. For example, in the Permian, there's, it's called associated natural gas. So when you drill for oil, you're going to get natural gas. When you drill for natural gas, you may not necessarily get oil. Right, so, right. It's like one of those old logic equations from college. But
if a train leaves...
Yeah, right. Right. If I throw a baseball 400 miles an hour and I hit it with equal force in the other direction, how bad did I break my hand?
Right.
So, yeah, it's so there's a lot of affiliated gas out there and associated gas. I always forget the term. But because there's gas coming, we actually are not seeing gas prices rise right now because there is an abundance of gas. So the oil surplus has really come down to it's basically just an average inventory at this point. There is no oil glut anymore. Natural gas, on the other hand, we still have quite a bit of natural gas, but we're seeing drawdowns. So if we get a very hot summer where everybody's kicking in on the air conditioning, we'd probably see a pretty large drawdown. So that's something to keep an eye on. The real driver for natural gas is going to be exports.
Right.
So as we ramp up more liquefied natural gas, LNG, export capacity, whether it's Sabine Pass or on the East Coast, there's a project. There's actually a couple on the Gulf Coast.
There's a bunch of projects going on. It's pretty remarkable, actually.
Yeah, well, there's only 4, though, that are really going to be producing in the next year or 2.
Okay.
So, FERC, FERC has approved several, but there's only 4 that are real close to production.
Gotcha.
So, Sabine Pass is the big one that's owned by Cheniere, and they're going to just keep pumping out natural gas. A few years ago, back when I was with MarketWatch, I said that, hey, we're going to see natural gas exports go from nothing to 4% of total production to about 12% of total production, and maybe 20% of total production by 2020. And I got mocked, which is pretty par for the course.
Right. Usually usually a good theme for you and people who follow you.
Yeah, right. So I get mocked, and anytime I get mocked, you should hold your nose and buy what I'm buying, because you're usually going to make some money.
Like that huge mistake you made with Exact Sciences a few years ago.
Yeah, I'm sorry. We only made 1,000%.
All right, back to oil. That was on me, but I couldn't pass it up. Okay, back to oil there.
Yeah, so with oil, what people have to realize is that because these companies can hedge their future production, and they're going to get a chance to do it at higher prices, and they've tightened their belts, and they're focusing on the best shale places, which will yield production for 3, 4, 5, 6, 7 years, depending on where you are. These companies are going to make a lot of money while the demand for oil is still rising, which I believe will be for another 10-ish years. You've got people out there who say oil demand is going to rise until 2040. I think they're wrong, but through the middle to late 2020s, oil demand is going to drift higher, but it's really going to almost plateau, which is why I call it the peak oil plateau. I think we're going to have basically supply just a little bit under demand for an extended period, keep prices in that 80 to 120 range. Hopefully we don't have any outbreaks of war in the Middle East, but I think we probably will, and that'll be disruptive. So, we have to keep an eye on oil, because, it does have a dramatic economic impact at this point. Every spike in oil prices, going back to, I believe, pre-World War II, but for sure since World War II, has been accompanied by a recession. So we need to make sure that we hold what I have been calling the Goldilocks price of oil, which will be in the 80s. As long as we don't get much past the 80s, it's not going to have much impact on the economy. We've seen the studies that when oil prices dropped, it didn't really affect consumer spending. So consumer spending doesn't really start changing until you get towards $100 a barrel and $120 a barrel. So we have to avoid that. But in the meantime, you have companies out there in the oil patch that, with the right acreage and the right processes and transportation to get their oil to market, through pipelines or on trains or in trucks, they're going to do very well. And one company in particular is going to be the leader in exporting Texas oil. And that's a company that I'm heavily invested in and have talked about for over a year and a half, almost 2 years now. And it's up about 30%.
Are you open to sharing publicly?
Yeah, so the company that I think for the dividend player, for the folks out there that own Chevron and Exxon, sell those and buy Occidental Petroleum. Occidental Petroleum is a leaner company with better assets, better balance sheet, and they have the ability to get oil out of Texas via the port that they the export facility on the port down in Corpus Christi that they are running. They're making that port deeper so they can put the very large container ships out there, the very large ships, and they're probably going to generate almost double the cash flow they have today in the next 2 years or so, or 3 years. I mean, their earnings per share could well more than double, and I think close to triple.
Wow.
Their CEO was on. She's a pretty smart person. And, by the way, it kicks out a 4% dividend. So, when I talk about oil companies, I'm really parsing it down to who has the best balance sheet and acreage and ability to grow and pay out dividends and shrink their shares outstanding and reduce debt. And Occidental kicks the crap out of Exxon and Chevron. So I'll tell you, the other thing to keep in mind with Exxon and Chevron is they have major legal liabilities coming. So at a bare minimum, they're going to have to fight very expensive lawsuits from multiple states and probably the federal government at some point. And
like environmental issues.
Oh yeah, for sure. I mean, we know for a fact that they've covered up climate change research, and whether people believe that it's mostly man or only a little bit man, I'm not going to argue that. But the fact that these companies lied and hid information, and we know that to be true at this point, there's going to be a consequence. And if I'm a shareholder, I don't want any piece of that. There's a reason why the Rockefellers have divested all of their Exxon.
And out of curiosity, where do you follow that? Do you just look at their foundation's holdings? Is that public information?
Yeah, I mean,
Okay.
heck, it shows up in Bloomberg articles.
All right.
If folks aren't reading Bloomberg, the free side, you're missing out. It's a great paper. I actually subscribe to their pay version as well as the Financial Times and Wall Street Journal. It's all in the financial press.
Gotcha.
When the Rockefellers who made all their money in oil say to Exxon, "We're divesting,"
Right. Wah wah. Party's over.
Yeah, right. That. Yeah, I don't even know what a good comparison to that is.
Yeah, that's notable for sure. Well, okay, so you sell Exxon, sell Chevron, buy Occidental, primarily because he says leaner, better assets, better balance sheet, better acreage, all that kind of stuff.
Right. They're one of the they're either the largest or there was a merger recently. So they may be the second largest producer in the Permian Basin. So they are the biggest producer or second biggest producer in the best basin out there. And they have a couple of other assets down in Colombia and over in the Middle East. And those are great assets too. But they're very, very focused at this point. And the money they're going to make from their midstream services from the Permian to the Gulf and by exporting from the Gulf, these are really huge catalysts that people aren't aware of. So if the market is missing something right now, that's what it is.
So Occidental, they're upstream and midstream company.
Yeah.
Okay.
Yeah, at this point they've built their own pipes.
Wow, that helps.
So
so you said, and so if someone's listening to this and they think, hey, Kirk, you sound smart. This sounds like a great idea, a great opportunity here. And you mentioned Occidental as a specific opportunity. And you mentioned a while ago, like, what are the key things that you look for in terms of a good opportunity to find good specific investments in this trend you're describing? Could you you mentioned best balance sheet, acreage. Could you go through those briefly again?
So really what you want to find are companies that are improving shareholder yield. And shareholder yield is the combination of a company reducing debt, which most people discount, buying back shares, and paying out dividends. So that combination of how they use their cash flow benefits the shareholder. Gotcha. So you want to find companies that have a combination of paying down debt, buying back shares, and paying you a dividend. And several companies have really started pressing the pedal down on that. Encana is a company that I started buying at $7, $8, $9 a share, and it's over 13 now. I think it's going over 20. And they have 4 major shale plays, 2 in Canada, 2 in Texas. They have both the Permian and the Eagle Ford. And then Montney and Duchovny, which I probably say wrong because I'm an X-Files guy. But I think it's Duchovny, or it's said in a very French way. Or Indian, I don't know. But, and I have no idea.
Kirk's from Wisconsin, everyone, just for the background, in case you're curious.
Yeah, I've seen
in Milwaukee, they all sound the same.
Yeah, we're all nasally and but
and Brewers.
Yeah, right. I'm going in about 2 hours here.
I believe you.
But Encana, they have just incredible acreage, and they're undervalued, unloved. and Royal Dutch Shell described what they were looking to buy in North America, and they described the only four places that Encana operates. Kind of makes you wonder if there's going to be a buyout there. I own calls on Encana, so I own the 2020 Leaps on Encana, as well as shares, and I'm regularly selling puts because I collect a good premium. And that's a strategy that people should be aware of. The oil sector is volatile, so on the dips, you can sell puts, collect a very big premium. Generally, the oil, then they rise back up, and you never have to buy the stock. But if you do buy the stock, so what? It's companies that you want,
right?
And in the meantime, the premiums are pretty fat because there's high volatility. The third company that I would tell people to look at, and I don't have a large position in this, I've been hoping for a pullback and I haven't gotten it, is Pioneer. And Pioneer Natural Resources is converting into a Permian-only company. They're selling all their other assets. And that money
why is that? Just because they just want to double down on what matters, on the best returns?
Because the Permian is the best spot. So they're going to become a Permian-focused company. They're going to sell everything else in pieces, 4 or 5 pieces that they have. That money will drop to the bottom line. It'll probably all get paid out as dividends and through share buybacks because they're already operating out of cash flow. And that's the thing to realize, is that in the past 3 quarters, all of these companies started operating out of cash flow. So they're not borrowing anymore.
Right.
Which was the main, bullet that the shorts were firing. They started with lower for longer on oil prices, and when that stopped happening and oil prices went up, the shorts started saying, well, but these companies just keep borrowing money and they don't pay back their debts, and they're never going to turn a profit. Well, in the first quarter and the last quarter of last year, that turned out not to be true. And now with higher oil prices, it'll be even less true. These companies are going to be cash flow machines. Take a look at Chesapeake Energy. I was on Forex Analytics in early April, and I had already established my position in February and March. I sold all my Chesapeake Energy stock, and I bought Leaps with the whole amount. So I told other people, hey, maybe only take half the money and buy Leaps. But I bought long-term call options on Chesapeake Energy, and this is an article that will be out this week. The binary trade here is that either Chesapeake would go bankrupt on low oil prices, or oil prices would rise, and they'd be able to wait it out and start making a bunch of money. Well, oil prices rose. They sold just enough assets to stay in business, and now they're starting to inch towards the spot where they're cash flow positive. Possibly late this year, but probably Q1 next year, Q3 at the latest. So sometime in the next year, Chesapeake Energy is going to be cash flow positive.
That'd be pretty profound. I remember, what was it, 2 years ago that stock dropped to like $1.30 in 2016?
Right, and it's up 50% since I told people to buy the Leaps.
A week ago. So, it's up 50% like in the last week.
Yeah, it's up. Well, for sure since the start of April, and the call options that we own at this point have doubled. And now, because we're higher than our strike price by more than the premium we paid, every time that the price of Chesapeake Energy stock goes up about $1, we double our money.
That's amazing. Yeah,
or we make 100%.
Yeah. Yeah, and of course that's probably room for another podcast, but talking about some of those companies, because I think if Chesapeake, obviously they've shifted more toward oil in recent years, but historically more of a natural gas company. But I think that would be a really fascinating conversation too, to talk about a lot of the natural gas opportunity out there as well, because companies like Chesapeake, even if those prices don't rise too much, like if they can just get the cash flow positive and stay on the healthy track, there seems to be a pretty great potential even at current or lower prices.
Right. And so here, I'll give you 1 minute on natural gas.
Okay.
The major catalyst I told you is exports. Well, what are they talking about with China? They're talking about billions and billions of dollars in natural gas exports going to China.
Sounds good to me.
If they cut that deal, which I think they will, China's basically already said, cool, let's figure it out. you're going to see some of the natural gas producers really shoot through the roof. Well, Chesapeake Energy is either the second or third largest natural gas producer in America. I think they dropped the third. There's a company that I really like called Antero. Antero has managed this whole collapse the last 5 years in natural gas better than anybody. They produce out of cash flow. They're not borrowing. They're up in the Marcellus and Utica, so they have natural gas that can go to the East Coast to supply the East Coast, which needs it desperately. But they also have the pipes that are in place now to get the gas to the Gulf of Mexico for export. So Antero is in great shape. I own leaps on, their leaps aren't that long. They only go out a year. So I'm hoping that they get longer term call options. But right now I have call options to January because I think summer is being forecasted out to be very hot across the country and across the world. So you're going to see more air conditioning being used. And then, of course, you have the heating season that comes into that. So as soon as we get two back-to-back extreme winter and summer and winter, either way that can happen, natural gas is going to finally pop. And that's what we have to look for is Wall Street put so much pressure on the oil and gas industry to operate within cash flow that they're all doing it now, which means that excess production doesn't happen, right? They only produce what they know they can sell at a decent price. So, the good news for them is they're going to be making some money. The bad news for us as consumers is we're going to be spending a little bit more on our gasoline and a little bit more on heating and cooling our houses.
Well, what's make up the difference by investing in Antero and Pioneer and Occidental? And then you can sell your winnings and go buy some gas.
Yeah, well, right. I mean, that is a way to be hedged to it. I'm only in 5 or 6 or 7 sectors of the economy at a time. The other, about half the sectors I ignore and half the sectors I'm in. So for your indexers out there who want to own a little bit of everything, I just tell you, you're doing it wrong. Ignore the half of the economy that's not going in the right direction and invest in the other half. And energy, technology, those are places to be. Telecom is turning around right now, and utilities, I tell you what, the guys who run utilities, even though they're facing major headwinds, are very good managers. And they do get a minimum return because of their government regulation. So, even some of the utilities are looking pretty sharp right now. Dominion has a part in a natural gas export facility in addition to being a utility. So, you take a look at what's out there and you say, wow, I mean, there are some players out there that because of what they're attached to, what they're doing, how their management has positioned them, the fact that they have good balance sheets, there's companies out there that will double and triple in the next several years, almost regardless of what the stock market and the broader economy do. So I would keep that in mind. And just one last thing that I will throw out there, and Jeff Gundlach has talked about this, and several other billionaire investors have talked about this. Gundlach talked about it at the Sohn investment conference. If you just want an easy way to get in to energy and to increase your asset allocation, the S&P 500 asset allocation to energy is 6%. I'm telling people to be between 15 and 25%. But even if you only wanted to double your allocation, the fund that I would use is XOP, the Spider Oil and Gas Exploration and Production ETF. Jeff Gundlach presented this as a best idea at the Sohn Investment Conference. I've been in it for a year and gone from 30 to 43. But I think when you take a look at the underlying companies, there's about 35 companies in here, and they don't own much Exxon or Chevron, just a little bit. It's an equal weight fund, so the mid caps and the Pioneers of the world and the Occidentals of the world get a lot of play. I think this ETF goes up to 60 to 80 in the next couple of years. It's 43 right now. So, it really depends on how high oil does get. But, these companies, they went through their painful period and they're ready to be bought by the masses. I'm a value and growth guy who got in earlier, but, these are still going to beat the market for an extended period, at least a year, probably 2. maybe 3.
Well, Kirk, hey, thanks so much for joining us. It's been fun to talk about oil and very compelling arguments as well. I mean, these are things that I know you've been following for a long time, and I've been following your work with them for a while, and it's really fun to see it bearing fruit. So thanks for joining us on the show, and have a great time this afternoon at the ball game.
All right, you take care.
The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.